I used to take loss after loss after loss, and no matter what I tried, the market just kept proving me wrong. That all changed when I learned about displacement. Since I mastered this, I've been able to consistently catch those explosive moves. And in this video, I'm gonna break it down step by step so you can too. You're probably wondering what displacement is. Displacement is when price moves strongly and decisively in one direction, usually breaking key levels of market structure. This matters because when you have displacement, you're going to be less susceptible to false moves and manipulation. You can actually see the momentum behind the move and expect continuation towards the direction of the breakout. Here's what you're probably used to seeing: a market structure shift without displacement. You can see that price closes above its swing high, but it barely pushes above it with a weak, smaller candle. There is no follow-through, and it reverses direction after taking out the high, leaving you in a bad position. Once you're able to spot displacement, you'll know whether price is truly breaking out or just sweeping liquidity. You can also confirm displacement when it leaves behind a fair value gap. That imbalance is not just a sign of strength, it's a chance to position yourself into the move. So now that you got the gist, let's break it down into a strategy. This is actually very straightforward. First, we're going to identify a range. Then, we wait for price to sweep liquidity on one side, either above or below that range. This initial break should be weak and not have displacement past that swing point. Once liquidity has been swept, we're looking for price to reverse and target the opposite side of the range. This time, we want to see a strong break with clear displacement, meaning one or more large candles closing decisively past the swing point. Displacement often leaves behind fair value gaps, and those are going to be our entry zones. We take the trade inside the gap, placing our stop just beyond it, and aim for a 1-to-2 risk-to-reward ratio. We could talk about a strategy all day, but let's walk through a setup together so you can really get it. Notice here, price is consolidating inside a well-defined range. There are no new higher highs nor lower lows, just sideways movement. Eventually, volatility kicks in and price briefly sweeps the range low. This move doesn't show true displacement. It's just a quick wick below the swing point, and price immediately snapped back upward. Shortly after, the market pushes through the swing high with strong displacement, leaving behind that fair value gap. That gap gives us our long entry. We can position our stop loss just beneath the fair value gap and target a 1-to-2 risk-to-reward ratio. Really quick, let's look at it from a different angle. Again, we're starting inside a range. Patience is key here. We want to see one side of the range get taken out with weak candlesticks. Our signal to prepare for shorts will be when price breaks below the swing point decisively. You'll notice that happening right here. The low was broken with displacement, and a fair value gap was created in the process. Using the same logic as our last example, this gap becomes the entry for our short. Place our stop above it, and aim for a 1-to-2 risk-to-reward ratio. Thanks for watching, and if you found this video helpful, I ask that you share it with someone else who might find it helpful too. If you'd like to see more content just like this, check out the other videos on our channel. Don't forget to leave a like and subscribe.